What if I told you that one of the safest dividend ETFs in the world is not only paying investors consistently, but is also quietly outperforming the market, even in 2025's rocky economy? While everyone is chasing hype stocks and riding the AI wave, a hidden gem is building real wealth with less risk, steady income, and surprising growth. That ETF is SCHD, and something major just happened that makes it stronger than ever. In this video, I'm going to break down the powerful changes just made to SCHD, why it's one of the top performing ETFs in 2025, how it's beating the market with a 13.4% average annual return, the secret reason also this fund could explode over the next 12 months. I'll walk you through the new updates inside SCHD, but more importantly, I'll explain why these changes matter to everyday investors. Personally, I've decided to increase my position after seeing this new setup. Plus, I'll share expert forecasts on where this fund might be headed over the next year. Right now, SCHD is still trading at a major discount. But here's the catch. Most people have no idea how to use SCHD properly. They either hold too little, expect too much, or give up too soon. By the end of this video, you'll know exactly how to use SCHD the right way, based on your goals and your risk level. This isn't just about dividends. This is about building real wealth with real strategy, and doing it the simple way. So, stick with me until the end, because what I'm about to show you could change how you invest forever. The top dividend fund just got an upgrade. One of the strongest income-generating ETFs on the market just became even more impressive. SCHD is already showing a 1.2% gain today, and is now rated a top pick on investing.com. The reason? SCHD has just finished its yearly reshuffle, and the updates are a big deal for long-term holders. In a year like 2025, where uncertainty is high, it's smart to lean on a steady low-risk fund, and in my view, SCHD leads the way. The year didn't start great. The S&P 500 dipped by nearly 2%. The Nasdaq 100 slid by more than 4%. Meanwhile, SCHD is rising. It's already climbed over 3% this year, making it one of the strongest performing ETFs of this year so far. And thanks to its recent overhaul, it's positioned to do even better. So, what's the difference about SCHD now? Here's why this fund stands out. Once a year, SCHD automatically replaces poor performers with stronger, more reliable companies. You don't need to make any changes yourself, just invest and let the fund handle the rest. As of last Friday's market close, SCHD made its latest adjustment. 20 new stocks were added, 17 names were removed, including big ones like Pfizer and BlackRock. ConocoPhillips is now among the top positions in the portfolio. There's more. The update also shifted the fund's focus. Exposure to energy companies went up by 8%. Weight in the financial sector dropped by 9%. These adjustments make SCHD more balanced and defensive, which is exactly what investors need in a year full of uncertainty. Why SCHD just became an even smarter move. Right now, the financial holdings inside SCHD are offering a 3.81% dividend return based on current pricing. What's even better, the fund has kept its edge, still offering strong quality, solid value, and reliable dividend growth, putting it ahead of most other income-focused ETFs. The latest update to SCHD is perfectly timed for rising inflation, just like we saw back in 2022. That's one of the reasons I'm holding tight and adding more, and why you might want to consider doing the same. Why? Because in 2025 we're seeing policy shifts, including tariffs, tax revisions, and other government moves that could lead to higher inflation again. And SCHD is designed to perform better in inflation-heavy periods. That makes it a smart tool to help shield your investments from economic pressure. With a 5-year beta of just 0.86, SCHD shows it's less volatile than the S&P 500, meaning it swings less during market ups and downs. If you're using SCHD as part of a 3-fund strategy, this is a big win. Stability, income, and long-term strength. New companies just added to SCHD. Here are the latest additions to the fund. Feel free to drop a comment with your favorite top 5 impact additions. Feel free to drop a comment with your favorite. Top 5 high impact additions: ConocoPhillips, Merck & Co., Schlumberger, Target, General Mills. I'm especially excited about ConocoPhillips. Analysts have marked it as a strong buy and is currently valued at around $112, while trading for only $102. That's a potential 10% upside. Let's break it down. Profit margins, nearly 49%. Very healthy. Price to earnings ratio, just 13. Low for a stock of this quality. Dividend yield, over 3%, and has been paying consistently for over 55 years. All of this points to SCHD being set up for serious gains, especially if more investors begin to notice what's happening. Why investors are shifting towards reliable value funds like SCHD. Many investors are now stepping away from chasing fast-growing stocks and ETFs and instead focusing on steady value-based investments. With today's uncertain economic climate, SCHD stands out as a fund that's ready to lead. And top market researchers agree, SCHD is currently considered undervalued by many. It's trading at around $28, but professionals estimate it should be worth $31.44 within a year. That's a possible 11.9% increase. Combine that with its over 3.5% dividend yield, and the total potential return could cross 15% in just 1 year. Even more hopeful projections put SCHD around $36.13 in a year. That's a 28% boost, which is impressive for such a stable ETF. What stocks were removed and why it matters? Let's take a look at the companies that were taken out of SCHD in this latest adjustment. 3 big names were dropped, and their exit had a major effect on how the fund is structured. Chevron played a large role, but many shareholders are actually pleased to see it leave. BlackRock's removal had mixed feedback, though I personally agree with the decision. US Bank Corp being dropped was unexpected, but after checking its numbers, the choice made sense. Remember, not all removals are due to poor performance. Sometimes a fund needs to rebalance, especially if one industry is taking up too much space. SCHD had too much weight in financial companies, so this was part of a necessary trim. SCHD is more than just safe, it's growing strong. The whole purpose of owning SCHD is to build long-term income. It offers steady cash payouts while keeping your portfolio less risky. But here's the exciting part. SCHD isn't just about safety or income anymore. Its ability to grow steadily is becoming hard to ignore. What makes this fund powerful? A combination of strong businesses, dividend strength, and real growth opportunity, all wrapped into one package. Why SCHD's strategy stands out from the crowd. This ETF follows a carefully designed method that focuses on choosing companies that consistently reward investors by increasing their dividend payouts over time. To even qualify for this fund, a company needs to have paid uninterrupted dividends for at least 10 straight years. This strict standard filters out businesses with unstable payout records, or those that are easily shaken by economic ups and downs. That's what makes SCHD different from other dividend ETFs. With many other income-focused funds, you get steady payouts, but little or no growth in share value. And with typical growth ETFs, you might see sharp price jumps, but also wild drops, like up 5% one week and then down 10% the next. SCHD is built differently. It holds steady, and the recent rebalancing has made it even stronger. SCHD's long-term performance proves its strength. Since its start on October the 19th, 2011, the fund has returned an average of 13.4% per year, beating the broader S&P 500, which has averaged around 11% during that same time. Looking beyond the short-term numbers. Sure, when people compare SCHD to high-growth funds like QQQ, it may seem like SCHD is underperforming, especially during the recent AI-driven rally. Growth ETFs have been leading the charge in the past few years, and SCHD has less exposure to tech. But here's the thing. When you take a step back and view the bigger picture, SCHD has shown steady growth, almost like a growth ETF, with the bonus of cash flow through dividends. Unlike other income funds that only chase high yields or stick to cheap companies, SCHD takes a well-rounded approach. It picks stocks based on multiple factors, including a track record of growing dividends, not just high yield or bargain pricing. Strong fundamentals, real growth potential, and long-term rewards. SCHD focuses on companies with healthy balance sheets and real potential for future profits. This well-balanced approach, along with its super low cost of just 0.06%, helps the fund deliver impressive overall returns. often outperforming other similar funds. By prioritizing a mix of high quality, steady growth and solid value, SCHD gives investors a powerful way to build wealth over time, while also enjoying a reliable stream of dividend income. This video is for educational and informational purposes only and should not be considered financial advice. I am not a financial advisor, so always do your own research and consult a professional before making any investment decisions. Your journey to financial freedom continues, and I'm excited to be a part of it. Here's to your investing success. Profitable investing.